Hello, class, and welcome to this lecture on money banks, the Federal Reserve, and monetary policy in our course on macroeconomics. To give you a roadmap of what we're going to discuss in this lecture, we're going to start by talking what the major functions of money are. We'll then talk about what the characteristics of usable money are. We'll then talk about the two kind of categories of money. We'll talk about what the money supply is and how it's measured. We'll introduce the Federal Reserve System in the United States and talk about the monetary policies that central banks undertake. We'll then talk about how banks create money and how there's a simple deposit multiplier. And then we'll finish the lecture by talking about cryptocurrency. So, why is money important? Well, in economics, it's pretty simple because of the fact that we're utilizing money in all of our variables. Aggregate supply and aggregate demand are measured with GDP, and GDP is measured in dollars, which is money. And if you're in another country, it'll be measured in a currency that's either dollars or relative to that nation. When we compensate each other, when we negotiate contracts, we're usually compensated in some form of money. And the reason why we do that is because money is a very efficient means to make the market transactions occur. It basically allows for transactions that could occur without money to occur much faster, much simpler. It makes it easier to assess value. It makes it easier to decide how someone's going to be compensated. It really is a means to assess value and to allow for more efficient transactions. So there are really four major functions of money. So the first one is a medium of exchange. So as I mentioned before, it's just, okay, if we're going to exchange goods or services or exchange valuable goods and services, how am I going to be compensated? Am I necessarily going to give you another good or service in exchange for a good or service? That's how a barter system works, but that's not necessarily efficient. So money can be used as a medium of exchange. The second major function of money is a unit of account. So GDP is an example of a unit of account. Basically, you have entire accounting majors, accounting courses on accounting for money in assets and liabilities and things like that. So we measure and we account for the values that we have and the amount of inventory that we have in money. So if a firm is trying to figure out, oh, I have $100,000 in inventory, well, where did that number come from? It could be 12,000 units, but if each unit is $8.50, that or cost to make it at a level of $8.50, then there's your answer of $100,000 in inventory. It could be a store of value. So let's say that you're growing vegetables or fruit, or you are selling milk. Well, you have something of value there, but it isn't going to last. It's going to expire, and you have this risk of potentially losing out if you aren't able to transact it for the goods and services that you need before it spoils. So money is a great thing, because if I sell a gallon of milk to somebody, if they drink it or not and it spoils for them, it doesn't matter to me anymore because I got the value that I got out of it. And they paid me what they thought the value of it was. So it allows for us to store value for times when we don't necessarily need it. So it really allows for savings outside of maybe hard commodities like gold. It's difficult to kind of save something that's not going to spoil. Now we can talk about inflationary issues, but in terms of the actual item itself, hopefully it won't spoil. And then lastly, standard of deferred payment. So if you're going to pay someone back in the future, interest or whatever, knowing kind of how that payment is going to be compensated in the future is important, and money can be a way of doing that. Now, what can serve as money? So not everything can be money. Well, technically everything can be money, but not everything can be a good, useful form of money. So if I have two old shoes that I can't use anymore, yes, those two shoes could be money. But they aren't going to fit the criteria of what can be suitable for a good, useful form of money. There are 5 criteria that are necessary in order for that to be satisfied. The first one is that the good must be acceptable by most people. So most people won't accept my dirty shoes as money. So it doesn't really fit the bill, no pun intended, while dollars do. Most people accept dollars as a form of compensation. The second one is that it should be of standardized quality so that any two units are identical. So in a way, maybe my shoes are the same. One might have a pronation wear that's different than the other one, but essentially they're both the same shoe. So in that way, that could be identical, but there's only two of them. But dollar bills, they are the same. So if I had $1 bill that looked like one thing and another dollar bill that looked like something else, I would be cautious and confused. So having them be of standardized quality and quantity allows for us to know that this one is equal to this one is equal to this one. So one George Washington $1 bill is equal to another George Washington $1 bill. The third category is that it should be durable, so it's not lost by spoilage. So milk, probably not the best form of money. It's going to spoil. Oranges, they might rot and get gross. Avocados, those aren't necessarily good to be as form as money. They might have value, but they don't have value for a long-term situation. So you can sell them and get money in exchange, or you could barter them for something else, but they're going to spoil and can't really be the money in and of itself. Dollar bills and coins are minted out of metal, and dollar bills are made out of kind of a fabric paper hybrid situation. So even if you run some dollar bills through the washing machine, they might be in a little rough shape, but they shouldn't disintegrate like if you have like a receipt or a napkin or a Kleenex that's stuck in your pocket. That's going to come out in bits and pieces, but like the dollar bill might be ripped a little bit, might be a little worn out, but in a way you just basically committed money laundering in a legal fashion. It should also be valuable relative to its weight. So this is the reason why we don't have $1 million bills. In the past, we might have had $1 million bills, but the largest denomination of a dollar bill in the United States now is 100. And the reason for that is because of the fact that the value has to be relative to its weight. So even though a $100 bill is worth 100 times that of a dollar bill, I would be very upset if I lost a $100 bill. But if I lost $1 million bill, I don't know what I would do, because it's difficult because you want to make sure that $1 million is a significant value relative to its weight. So if you actually have a briefcase full of $1 million, well, that's, let's see here, $10,100 bills. So that's quite the size and volume that it's going to take up versus just one single $100 bill. So $1 million is relative to its weight in terms of actual dollar bills or coins. Meanwhile, if you had $1 million bill and that was just $1 bill and you lose that thing, that can be problematic. There is a country, Micronesia. There's an island called Yap, and in their country, they had something that was called the Rye Stone. And it was this giant wheel, looks like that. Looks like a donut, but made of stone. So the Rye Stone, basically, it was so big and so valuable to that tribe and culture that it was almost never moved. So let's say you buy a house with a Rye Stone, but it's in your living room. It doesn't actually have to be transported to the bank. The bank will just believe, you know what, the Rye Stone is mine now, and the community believes that the Rye Stone is the bank's now. So instead of wheeling this 2-ton piece of stone out to the bank, people just transact something that might be in someone else's living room and say, well, I possess it now, and if I want to move it, then I'll move it. The craziest example of this is that a family was trying to move from one island to another island, and they had 3 Rye Stones attached to their boat, and there was a storm or tempest or something that happened in the ocean, and the family's rhinestones got disconnected from the boat and sunk to the bottom of the Pacific. So imagine, it's just like the feeling, imagine you're like the feeling of losing that $1 million bill there, losing those 3 rhinestones. Terrible, right? But what's funny is the community had this system where it didn't really matter where the thing was. It just mattered that it was, people knew where it was, and who possessed it. So the thing is that those 3 rhinestones are still sitting at the bottom of the ocean, but they still function as currency, and those stones keep getting traded every now and again. So like you could own a piece of currency that's 1,000 feet below the surface, but it's still acceptable to them. And then lastly, the medium of exchange should be divisible, so different goods are valued differently. So this allows for us to have more equitable distribution of pricing. So if you had only like 2 of something and it wasn't divisible, it would be hard to kind of assess value because it's not divisible enough for us to be able to kind of be like, okay, well, it's either worth 1 or 2 and nothing else. You can't divide it up into fractions. It can't be bigger than 2. So if your decision is 1, 2, or nothing, very difficult to be able to assess value fairly between products. So this is why dollar bills are divisible by 100, and that's why there's enough of them out there where things can have significant value. When we talk about cryptocurrency, Bitcoin is divisible by 100 million, and so an individual 100 millionth of a Bitcoin is known as a Satoshi, and so basically a Satoshi is like a penny. Or maybe someday if Bitcoin becomes big enough, a Satoshi could be $1. And I'm hoping that happens because I own some Bitcoin. But generally speaking, we want it to be divisible so it can be valued differently, so we can assess truly how much something is worth within that money currency. And so dollar bills meet all of this criteria. So it's acceptable by most, it's standardized, it's durable, it's valuable, and it's divisible. Maybe not by as much as it could have been, or as it would like to be with the hundredths, but it's still divisible. So prior to this system with money, we had what was known as a barter system. So basically, in order for you to make a transaction, it had to be a service for a service, a good for a service, or a service for a good. Because there wasn't really currencies that were useful prior to it. So this is problematic, especially in terms of thinking about like an income inequality type situation where basically you have a family that needs some bread or needs some sort of medicine, and they come from a kind of less fortunate or lower income part of the community, and the provider or purveyor of the bread or the medicine or the pharmacist comes from like an ecclesiastical, bourgeois, richer side of town. And if that's the case, then there might be a limitation in terms of what the poorer family could use to transact in exchange for the bread or the medicine. So maybe a wealthy family has something that isn't that valuable kind of by the public or extraneously, but to the person that is purveying that bread or medicine, they might find it to be valuable, so they're more likely to exchange for that. Meanwhile, maybe you have this poor family doesn't really have much that more wealthy individual would want, and so they might end up having to pay more and pay something of higher value to get something that someone else got for a different price. So this allows for us to kind of make less discriminatory transactions. So you might have heard the term that money don't discriminate. And the reality of that is as true as, in a way, money has no kind of emotional connection. It just exists as a form of transaction and value. So if $1 comes from someone poor, someone rich, someone black, someone white, it doesn't really matter where it comes from because it still has the same value no matter where it was derived, assuming it's real. If it's counterfeit, then it doesn't have value. But assuming that is the authentic item or dollar or currency, then it doesn't matter where it comes from, which allows for more kind of equitability in transactions. It also allows for kind of a one price system. So if we didn't have money as a means of exchange, then our equilibrium graphs that we've derived all term wouldn't even be useful. Uh, Subsequently, you can also think about the spoilage thing that I talked about before, where you grow vegetables or fruit, you only have so much time before the crop is spoiled. So having money allows for you to be able to withhold that value over the year. Meanwhile, if you weren't in that system, you would basically have to make a transaction for all of your goods and services at the harvest, or else you wouldn't have uh, anything until the next one. So money is a very effective and convenient and efficient means for our market system. So there are two types of money that we can categorize. So uh, prior to the um, current system we had something that was known as the Bretton Woods system. And that was an example of the commodity money system. So you might have known it as the gold standard. Commodity money is just something that has value independent of its use as money. So gold depends on its purity or functionality. So gold has usefulness outside of being money. So the thing is like in reality, most people don't really have a usefulness for gold outside of jewelry or things like that. It's very useful in terms of conduction for metals and electronics and things like that, but generally speaking, it still doesn't really have much value other than being cool looking and heavy, which makes it durable and valuable intrinsically to individuals who find the shininess to be attractive. But I personally don't have any gold. Personally, individually, I don't have any gold, but it's not a terrible thing to invest in terms of a commodity. But anything can be commodity money if assuming it fits those 5 characteristics I mentioned before. So back in the day, if you've heard of the term worth their weight in salt or worth their salt, so you might have heard worth their weight in gold, or you might have heard worth their salt. Both of those are commodities, and both of those terms come from the fact that there were historical times in which people were compensated in gold or they were compensated in salt. So there was value for salt outside of just using it for transactions. The reason why it was useful in transactions and was used as money was because that salt was then used to preserve meats over the winter after you would take care of the slaughter. So fiat money, on the other hand, is money that is authorized by a central bank. And that's what we have now. So again, commodity money, it could be water, it could be wood. You could have the wood standard, the water standard, the salt standard. In fact, if you talk about what's known as the diamond water paradox, diamonds have high value, one, because of monopolization by De Beers, but secondly, also because of the fact that they're rare before we got into lab created diamonds, but mined diamonds are rare and people really like them and people really want them. So high demand, low supply. On the other hand, water is cheap, but it's absolutely essential to life and agriculture and things like that. But it's a high supply generally and neutral demand. So it's weird because water essentially has way more utility than a diamond does, but a diamond is way more expensive than water. So you could effectively have like the water standard where basically you get paid in water allotments so you can live. And just like the salt standard, so you had the salt so you could live, so you could at least have meat throughout the winter. So That is different than what we have today. Today we have what's known as the fiat money system. And its only value comes from the fact that people believe it to have value and that it's backed by some entity. So fiat money is backed by a central bank or a governmental body. It doesn't have gold attached to it, so you can't go to the bank and say, I've got $5,000, I want gold in exchange for it. That's not how the system works anymore. If you have $5,000, you have $5,000 in United States dollars. If the U.S. government collapses, you now have nothing. That's just how it is. Could it still have value even without the United States government because people are so used to it being there? Potentially, but generally speaking, probably not, because if the U.S. government collapses, plausibly they could print as much money as they want to, so then the value of it would diminish, similar to what happened in World War I with Germany, and also with Zimbabwe a few years ago, where inflation was so out of control because the government kept printing money that inflation was 1.6 million%. So I don't even know how to process that number, but it happened, and it was so crazy that like you could take your $1 billion banknotes to the bank and the next day they would stamp trillion on it, and now you were a trillionaire, but you still couldn't even buy groceries. So fiat money is tricky because of the fact that it's completely dependent upon people believing it to have value and it being backed by a governmental agency, which is one of the arguments for why cryptocurrency is popular. But when we talk about crypto, we'll talk about the pros and cons associated with it. So how much money is actually out there in the economy? There are two ways in which we can assess this, and this is known as the money supply. So if we're focusing on the money supply of United States dollars, there are two ways in which we can assess it. The narrowest measurement of money supply, which implies the most liquid of the assets that could be considered money that could be used for transactional purposes, is M1. And all M1 includes is currency, so that's dollar bills and coins. Checking account deposits, so think about if you have a checking and a savings account, only the money that that exists in your checking account counts for M1 in addition to your currency. The last thing that also counts in M1 is traveler's checks or cashier's checks or things like that. Traveler's checks are so infrequently used now that basically there are rounding errors, so some measurements won't even include it because it's a couple $1 billion, which is quite a bit, but relative to our overall money supply, which is in the trillions, it's a fraction of a percent, and so in a way it could just be a rounding error. M2 is more broad. Now, M2 is not its own separate entity from M1. M2 is just a broader, more holistic way of assessing money supply and thinking about, okay, well, how closely connected can we jump something from M2 to M1? So M2 is going to include everything in M1 in terms of liquidity, so currency and cash, so coins, and the checking account deposits, but it's also going to add in the savings account balances. So if you have a checking account and a savings account, M1 just includes the checking account and whatever's in your wallet. M2 includes both of those accounts and everything that's in your wallet. It also includes small denomination time deposits. It also includes balances in money market mutual deposits. And it also includes non-institutional money market funds shares. Basically talking about deposits that have a short date to maturity, so they'll be liquid in a short period of time, and also deposit accounts and mutual funds that are related to actual money and currency. Because all of it's related to money, all of it is relatively liquid. Savings accounts used to be that you could only access money from your savings account if you went into the bank and withdrew it. Nowadays, you could pay your phone bill with a savings account, or pay your car insurance with a savings account, or pay, I don't know, for Spotify with your savings account, based on how kind of closely connected these things are. M2 isn't quite as different as M1 is these days. So this figure is going to show us the difference between M1 and M2. So these measurements are coming from the Federal Reserve Bank, which we'll talk about momentarily. The left-hand pie chart, which indicates, which is denoted as A, indicates M1, which at this time, it's bigger than this now, but at the time in which this graph was created, it was $2.1 trillion. So 2,000 billion is $2 trillion. $977 billion, so almost $1 trillion just in cash and coins. So $100 bills, $1 bills, $5 bills, $2 bills, $10 bills, Kennedy half dollars, Sacagawea dollars, pennies that are on the floor and in your couch and in your car, in the trunk. All of those accumulate to $977 billion at the time. Checking account deposits were about $1.1 trillion. So, and then travelers' checks again, $4.4 billion. So small relative to these big numbers that are even, these numbers are about to get dwarfed by M2, but when you have $4.4 billion relative to $2 trillion, that is not a lot. So, that's like, I think, 1/500th, maybe a little less than that. So 4 over 1,000. So yeah, we're looking at 1/500th of total. So that's looking at 0.2% of the contribution of money supplies travelers checks. Meanwhile, it's about 46.5. 46.8 in terms of the distribution between checking accounts and currency. Now again, remember M2 includes everything from M1. So in order for us to be able to calculate M2, look at that green slice on the right-hand pie chart, and you see that that's everything that's in the left-hand side. So all of this is just this little piece right here. So savings deposits dwarf anything that's in M1. So if we're looking at the most liquid of the liquid, that's why we separate them, because savings deposits could be for, you're not going to spend it, you're saving up for a house, you're saving up for a car, you're saving up for retirement, whatever the reason. The reason why it's considered money is for two reasons. The first reason is that nowadays it's not that far removed from being checking money, that you could just do a transfer in 5 seconds on your online banking and then now have that in your checking account, so you can just kind of ping pong money back and forth between accounts. The other reason is because of the fact that we'll learn in this lecture that banks create money by loaning out money that's saved. They don't just keep it in a vault, they loan it out because they want to make money too. And so that money, even though it's saved, might not be available to be spent by the person that's actually saving the money, but it could eventually be a loan to somebody. So it's reasonable to count that. And then small time deposits are about 800 billion, and then money market mutual fund shares are about $715 billion at the time that this was created. So M2 much more substantial than M1. So when we talk about monetary policy and increasing the money supply or decreasing the money supply, this is what we're doing. We're injecting money to make that number, those numbers bigger if we're increasing the money supply, or the central bank will be pulling money out in the form of securities, selling to basically decrease this number. So now I want to turn my attention to the Federal Reserve System. So the Federal Reserve System was established by Congress in 1913 to help avoid panics and bank runs. So nowadays we kind of think of the Federal Reserve as a policy-oriented industry or institution in the government, but really it wasn't really interested in money supply and all these control factors. It was really just there as a centralized force to help kind of stabilize the banking industry that was going through rough times in the early 20th century. So a bank run, which this will make a lot more sense when we talk about how banks operate and how they create money. But basically, a bank run is just a situation when all or many of the depositors decide that they're just going to pull their money from a bank. So let's say that everybody at your local credit union decides to cash out tomorrow. Will your credit union have all of the money that is on their books to pay you back? The answer is no. They won't even have a fraction of that amount. So let's say 90% of depositors demand their money at any given time. Probably 1 in 9 of them will be satisfied with getting their money. The reason for that is because of the fact that the bank is loaning out money consistently. And before the Fed system existed, they could have plausibly loaned out every single dime that they had and had like maybe $20 in their vault, if they even had one. Because the more you loan, the more money you make, because the more you loan, the more interest you generate when you get your payments back, which allows for you to be profitable. Banks are not charities by any means, so their goal is to make money, just like your goal is to not have it be stolen. But the problem with that is that your money isn't just sitting in a vault till you want it. It's going to be floating in the abyss in the form of Farmer John's farm or Susie's local business or Corporation A's corporate fund. So if you're in a small town and the bank lends out 70% of its assets to Farmer John for crops, and then they plan on getting a significant return based on the yield, and then there's a drought that year and Farmer John makes nothing, then the bank's not going to get their money back. Farmer John goes bankrupt. Like the wind carrying the seeds through the farm and into the plains. Basically, the wind and the word is traveling that Farmer John is insolvent and bankrupt. And if everyone knows that Farmer John got his loan from local bank number 5, then everyone's going to go running to local bank number 5, who's a depositor at local bank number 5, because they're afraid that there isn't any money there. So if they're first in line, maybe they'll drain the vault cash and be able to get their money back, but everyone behind them will end up with nothing, and everybody loses everything, which is why the running joke of storing your money under your mattress is a thing. A bank panic is worse. It's when you scale up bank runs to multiple banks, and then things get crazy. So the Fed was basically established to try and create some safeguards that would mitigate this problem. So here's the Federal Reserve System. There are 12 districts and the Board of Governors in D.C. The Board of Governors are basically responsible for overseeing the system. 7 of the members are appointed by the president and serve a 14-year term, and 1 member is appointed by the chair and serves a 4-year renewable term. These days, the main focus for the Federal Reserve is for monetary policy, and so there is a committee within the Fed that's known as the Federal Open Market Committee. And this committee is formed from 12 members, the 7 Board of Governors, the President of the Federal Reserve of New York, and the reason for that is when the Federal Reserve undertakes transactions, most of them are coming through the New York Fed. So we have 12 district banks all in different regional portions of the country. But New York, when they engage in what are known as open market operations, that's why it's called the Open Market Committee. Most of that's done on Wall Street in New York, so basically they figure that it's important for the New York president of the Fed to be at the table at all times in terms of policy, because they're going to be the one implementing it. The other 4 seats are determined on a rotating basis from the other presidents from the other 11 district banks. And as you can see, this system was created in 1913. So the district banks that exist were population centers in the early 20th century. So even though almost a third of the United States lives west of the Rockies now, there's only one Federal Reserve District Bank for Alaska, Hawaii, and the western states. So the reason why, Cleveland is a Fed district mainly because of the fact that it was one of the 10 most populated cities when they established the Federal Reserve System. So they basically cover western PA, Ohio, and half of Kentucky. And then Chicago covers Michigan, the lower peninsula of Michigan, and then kind of the northern portions of Indiana, Illinois, Iowa, and the southern part of Wisconsin. And then Minneapolis takes care of kind of the northern states that aren't in the PNW. It's interesting because Missouri has 2 district banks. You wouldn't think that now, but they do. Kansas City is on the western portion of the state, and St. Louis is on the eastern portion. The St. Louis Federal Reserve District Bank is important because they are in charge of the Federal Reserve Economic Database. So they are keeping themselves busy and important with that. But we also have district banks in Dallas, Atlanta, Richmond, Virginia, Philadelphia, New York, and Boston. So what does the Federal Reserve do outside of open market operations and monetary policy? Because that's kind of what they do now. But initially what they did was they existed to be what's known as a lender of last resort. So if a bank runs out of money, so maybe there are 2 reasons for this. The first reason is that the Federal Reserve mandated that every bank withhold a certain portion of their deposits every day as reserves, basically as a safeguard against them running out of money. Right now that number is around 10%. So 10% of so think about if you deposit $1 in the bank, 10 cents of that is going to a vault as mandated by the Federal Reserve. But there are going to be days in which a bank has a mortgage closing or something like that where the amount of money that they lend out is more than the amount of money that they got in deposits. Now, the Fed doesn't care about that. The Fed still wants their money at the end of the day. Or if there's a situation like a bank run where a bank doesn't have the assets to meet the depositor demands, they can borrow that money from other banks. Generally speaking, they will do that. So like maybe one bank didn't lend out as much, so they have some extra reserves, so they could basically make some money on their reserves by lending it to that other bank that needs the money, and then that other that other bank will pay them back with their deposits in the next day. But if they can't find a bank to do that, they can just borrow the money from the Federal Reserve. So the Federal Reserve serves as a lender of last resort. If they run out of funds, no bank wants to deal with them, the Federal Reserve can and will lend them the money. But it's not free. They are charged an interest rate just like banks would or any institution would, and that is known as the discount rate. So discount loans, if you've heard of discount lending in the news, it basically just says that these are loans that the Federal Reserve makes to banks. Now, you can't personally go to the Federal Reserve for a bank. So the central bank is a bank for banks, not a bank for people. So if you decide, oh, you know what, I'd like $100,000 from the Fed, they don't need it. Can I borrow from the Fed? Can I borrow? What's the interest rate? The interest rate seems pretty good. That is not plausible. You can't do it. You have to be an actual bank in order to be able to work with the Federal Reserve in terms of borrowing money. And then again, the other way that the Federal Reserve kind of is looked at these days in terms of relevancy is in terms of how they affect the money supply through their monetary policy. So there are three types of policies that the Fed can undertake. The first one is known as open market operations, so that's why it's called the Federal Open Market Committee. The second one is the discount rate, which is again that interest rate that the Fed charges banks to borrow from them for overnight because they haven't met their reserve requirement or they have a run on their deposits. The last one is that reserve requirement situation. So again, 10% of every deposit must be withheld by the Fed every single day. But the Federal Reserve could change that at any time. They get to say, you know what, 20%. You guys don't know how to take care of your money. You're giving out crappy loans, so I'm going to make you hold more money. They could lower it to 5% to be like, oh, we really want more people to lend, so let's lower the amount of money and you can try to lend as much as possible, but then there's a potential moral hazard issue with that. But the main one is open market operations. So in our discussion about aggregate demand and aggregate supply, I talked about expansionary versus contractionary policy. Expansionary monetary policy is important in times when the economy is struggling. So what the Fed will do is they will increase the money supply. Now, how is that going to affect the context of our economy with ADAS? Well, the reality is that if you increase the money supply, it increases the amount of money that's available, which should put downward pressure on the price of borrowing money, which is the interest rate. When we talked about aggregate expenditures and aggregate demand, if you decrease an interest rate, if you decrease the interest rate, that's going to put incentives and make it cheaper to borrow, which usually is going to put upward pressure on consumption and upward pressure on investment. So if the Federal Reserve wants to engage in expansionary monetary policy through the open market, they're going to buy securities. So securities, again, are usually bonds, treasury bonds from the government. In times of quantitative easing, it was mortgage-backed securities and agency debt. But generally, it's basically a IOU that someone is going to pay someone else at a certain date. But until that date comes, it's just a piece of paper that has value but isn't something that I can actually spend some money on or buy something with or invest with. So what the Fed will do is they'll say, you know what, I'll take that security off your hands and I'll give you a decent price for it so you can now have the cash to do what you want to do. So maybe a company wants to build a new facility, they want the cash. Or maybe you're holding a bond and you want the cash. Now, the Fed won't sell it directly to you. It's usually the open financial market. I mean, so technically they could sell it to you if you're online or something like that. But generally speaking, instead of them working distinctly with the banks, they're just like, hey, financial market, here's some cash. I'm just going to throw some money around, flood the market with cash. I'll buy up your pieces of paper that you can't do anything with. So that way there's more money circulating through, which puts downward pressure on interest rates, and that puts upward pressure on consumption and investment. On the other hand, if we engage in what's known as contractionary monetary policy, the reason for this is for inflation problems in the economy. So we've if we're up on that classical model, that potential GDP, and we see upward pressure on wages and prices, but we're not really seeing much economic growth consequentially coming from those increases in prices and wages, then we might engage in what's known as contractionary policy, which is basically a situation where we're going to do the opposite. The Fed is going to sell securities. So all those IOUs and pieces of paper and bonds that they're sitting on, they're going to take that back and send it into the financial market and try to sell it at a decent price so a person feels like they're going to get a good return on their investment. And in exchange, that financial institution or that person is going to then give them money, the Fed money. They're going to buy the security from the Fed who's selling it, and then the Fed takes that money that they bought with the security and they sit on it. So basically whatever they are buying, they're sitting on it. So if they're buying securities, they're going to sit on it. If they're buying or if they're selling securities, they're just going to take the money that they're getting in as compensation and sit on it. Well, if they're sitting on it, then it's not circulating through the economy, and as a result, you get a downward pressure on money supply and upward pressure on interest rates, which usually will reduce consumption and investment. So let me draw a couple of graphs here. So here is going to be the market for loanable funds. We're going to call this money. We can use dollars, I guess. And this is going to be the interest rate. Now, we have a certain amount of demand, we'll call MD, money demand, for actual money to borrow. And then we have money supply as it currently exists. Just like any sort of situation, you have an equilibrium. And so this is the market interest rate at this current situation. If the Fed engages in expansionary monetary policy, this curve is going to shift to the right. And we're now going to have a new equilibrium down here. And our interest rates are going to be lower. And if interest rates are lower, as identified in the aggregate expenditures model and in the aggregate supply and aggregate demand model that I'm drawing, we're going to start from this equilibrium point, which is facilitating the need for expansionary monetary policy. So again, we're falling short of our potential GDP here. This is our actual GDP. This is our price level, and we want to be here. So if they're engaging in monetary policy, increasing money supply, lowering interest rates, well, if we lower interest rates, that usually increases consumption and investment, which are both demand side factors. So we end up shifting the aggregate demand curve to the right and hopefully ending up at our long run equilibrium. So yeah, there's upward pressure on prices, but we're also getting discernible economic growth as a result. So that's the reason for it. Contractionary policy is going to be the opposite, where basically we're going to end up shifting backwards, which is going to put upward pressure on interest rates. And if we put upward pressure on interest rates, then we end up shifting this curve to the left, down. Now, again, we wouldn't engage in a contractionary policy at this point, but we might engage in contractionary policy in an example like this. So we have aggregate demand here, short run aggregate supply here, and we have our long run aggregate supply curve here. So potential GDP is here, actual GDP is here, which seems great, but inevitably what's going to happen is one of the variables that affects short-run aggregate supply is adjustments to prices and wages, and when you have a tight labor market like this, and you're not getting a lot of long-run growth as a result, you're going to end up shifting this if you don't do anything, and you end up losing that GDP anyways, but with higher prices. So to try and combat that, the Fed will engage in a contractionary policy to try and shift aggregate demand to the left and basically be at the same point but with a lower price level. So that's really the point of monetary policy, but the important thing to take away from monetary policy is that it's indirect. It's direct in the fact that the Fed is putting money into the system and into the market. The problem is that the interest rate that actually fluctuates is not one that they can control. The only interest rate that they can control is the discount rate. The interest rate that they target publicly is not the discount rate because they could just change that however they want, but instead it's going to be the Fed funds rate. And the Fed funds rate, or the federal funds rate, is the interest rate that banks charge other banks for overnight loans. So going back to that example where the bank lended out too much money and they need to borrow some money from somewhere to meet their daily reserve requirement. Generally speaking, they're going to get that money from another bank. And so if they're getting that money from another bank, the interest rate that the bank charges can be whatever they want it to be. But generally speaking, if multiple banks have options and there's a certain market that kind of dictates that rate, that's the rate that the Fed is going to charge. Now, the Fed could target any interest rate. They could target mortgage rates. They could target car loan rates. I mean, most interest rates are based on creditworthiness and inflation, but generally speaking, they could target whatever interest they want because a rising tide lifts all boats. So basically, a rising Fed funds rate lifts all interest rates. A lowering interest rate lowers all interest rates. So the reason why they use the federal funds rate is because it is the interest rate that is most closely and intimately connected with their actual operations. Because the only reason why a bank needs to borrow from another bank, because most of them aren't going out of business every day, is to meet this reserve requirement that the Fed is forcing them to abide by. So if it weren't for that, there probably wouldn't be much lending between banks overnight. Because why would you need a one-day loan? It's to meet the reserve requirement. So rather than kind of manipulate an industry too intimately, so like, oh, we're just going to tie it up with mortgage rates, well then like the whole economy revolves around the housing sector. So rather than do that, they focus on an interest rate that they can't specifically control, but is so intimately connected with their day-to-day operations that it makes logical sense that they focus on that one. So again, banks that have excess reserves. In fact, banks who don't end up lending their money to banks that need it for their daily reserve requirement actually do get interest on excess reserves from the Federal Reserve. So there actually is an incentive in some ways. So during the Great Recession, the interest rate for excess reserves was higher than the interest rate that banks could actually charge out in the open market. And so instead of actually lending money out, they just sat on it because it was a low risk and a higher reward. And so that is one of the reasons why monetary policy wasn't as effective and can be less effective than, say, fiscal policy. And this is kind of the Keynesian rationale for it. The reason why is because everything has to happen in order for it to work. Because not only the Fed has to buy the securities, inject the cash has to go to the bank, and then the bank has to make a conscious effort to lend. So interest rates could be 0.2%, but if the bank is not lending the money out, then that causal relationship that we see between interest rates and aggregate demand, the chain is broken because there's a step in between. It's always contingent upon the bank actually lending. If the bank isn't lending, then nobody can borrow, so the interest rates are inconsequential at that point, and the policy won't work. And so it didn't necessarily work during the Great Recession because of those reasons. Speaking of the Great Recession, we can talk about quantitative easing. So quantitative easing was an action that was first taken by the Federal Reserve in 2008. It was initially done by Japan in the 90s, I believe. But the Fed was their hands were tied because the Fed funds rate that they focus on was targeted at 0%. And in a way, you can have negative interest rates, which means that you pay someone to borrow money from you, which is very strange. But stranger things have happened. In 2020, oil prices for futures contracts in the middle of the year were like negative $37 a barrel. So basically, you could get a contract to be paid to take oil because there was low demand due to COVID-19, and so all of the kind of warehouse facilities that withheld all of the kind of crude barrels were at capacity, so someone needed the oil to go somewhere. So I I was even thinking up with one of my colleagues at the time to be like, okay, how many barrels of oil can I fit in my garage? How many can you fit in your truck? Because man, like we could get paid $1,000 to just hold this, and if the oil eventually becomes $30 a barrel again, then you sell it again for positive $30. So you make $2,000 or $3,000 on for just holding oil for a while. Strange time. But anyways, instead of focusing on treasury bonds, so when the Fed engages in open market operations, they're usually buying treasury bonds. They instead were buying mortgage-backed securities because of the fact that a lot of this was triggered by foreclosures and the collapse of the financial market and the collapse of the housing industry. So a lot of these assets that were traded and people had on their balance sheets as banks that were in the billions of dollars were worthless because lots of people were just kind of delinquent on their mortgages and getting the houses foreclosed on. So what the Fed decided to do is like, okay, we'll throw you a lifeline. We'll buy these mortgage-backed securities off of you so that way you have cash to now share with the economy. And now the reason for that was twofold. One, they wanted to get the economy started again. They wanted banks to be willing to lend, more willing to lend, but also what the goal was is they wanted to shorten and lower yields on longer term interest. So like maybe short term interest rates were at 0, but maybe long term interest rates were at 3%, and they wanted to lower them to 2%. And the reason why they wanted to do that was they wanted to get the long term interest rates that people were in a flight to safety to invest in because of the fact that it got higher returns than anything else. They wanted to disincentivize people doing that and make the most profitable thing to do be lending out to actual individuals, companies again. And then QE was implemented again in 2020. It was actually a pretty quick drop. So interest rates were dropped from around 2% to 0 in a matter of about 40 days when the Federal Reserve realized, oh, COVID-19 is going to have a significant impact on the macroeconomy, so let's do our best to kind of get ahead of it. They basically committed to unprecedented. So I think the original QE program was $800 billion. The Fed's initial QE process in 2020 was $1.2 trillion. So it was a massive undertaking and basically round 2 of the same process. But instead of it being mortgage-backed securities, they were kind of just holding treasury debt, which was a kind of almost like a hand-in-hand type thing because the Fed committed to buying those securities, but simultaneously the federal government was issuing out a couple $1 trillion in stimulus in the form of small business loans and stimulus checks to households and federal aid to cities and states as a result. So kind of went hand in hand there. So open market operations are the main focus of monetary policy, but technically discount rate adjustments will impact the overall market, just not to the same level or to the same extreme. And again, remember the discount rate is not the Fed funds rate. The Fed funds rate is set by the market. The discount rate is set by the Fed. So if the Fed wants to induce more lending, they could potentially lower the interest rate that they charge to borrow. And if they want to disincentivize lending, they might raise that discount rate. It would have the same effect that it would as I showed in the loanable funds market, just to kind of a lesser extent because the discount rate is so closely connected with banks and overnight lending. And then the last one is required reserves. So again, the Fed requires 10% of all deposits to be in reserves. So that means you're just working every single day with 90% of the deposits that you receive as a bank. And again, it's there as a safekeeping thing. So you know that like if there's a run on your bank or there's some sort of insolvency issue, you can dip that reserve is there for your depositors. The problem with changing the reserve requirement is it's been this way, I think, since the 90s, maybe even the late 80s. So if you decide, you know what, as the chair of the Fed, that you want to make this 20%, okay? Now that means that every bank who is already living under this situation and this normal behavior of, okay, 10 cents of every dollar is going to the Fed today, and you double that to 20%, that is going to basically take away 1/9 of the overall working capital that that bank has to make money. And so imagine if you're buying your dream house and then all of a sudden the Fed's like, you know what? Your bank needs to withhold more money. And then the bank says, well, we can't afford to close on this mortgage with this in reserves now. They might have to make some really awkward situations where, guess what, that loan that we promised you, we can't do it anymore because we have to withhold this as a reserve. So that could be very problematic. So that's why they don't change it, and they haven't changed it for a long time. So now I want to turn my attention. So I've talked about this a couple of times, and the fact that banks are in the business of making money, and the way they make money these days is to charge you stupid fees. But traditionally and historically, the way they make more money is to issue loans. So if you have a car loan, student loan, mortgage, all of those are usually through financial institutions. You borrowed money and you pay an interest rate, and for them the goal is for the interest to be worth more than the amount of money that they gave you. And by meaning worth more, I'm talking about that Fisher equation before, where again real interest rate is equal to nominal interest rate minus inflation. So their goal is to charge you a nominal rate that is bigger than the inflation rate over the life of the loan, so that way they get profits on that. And so at the beginning it's tricky and scary because you've got a lot of capital going out the door, but as time goes on and you've got a bunch of mortgages and a bunch of homes and a bunch of cars out there, all those payments are trickling in time and time again, so your flow is consistent. So we also mentioned that the Fed requires every bank to withhold a certain number of their assets, which limits the amount that they can actually loan. So typically, if this didn't exist, they would almost have an incentive to loan out 99.9% of what they get in deposits. They want to not give away everything, so that way there's not this bank panic crisis that happens when one person tries to take money out or make a payment on anything. But otherwise, they would be interested in trying to loan in as much as possible, because the more loans they make, the more profitability they could have on the return from the interest. So there's going to be a drag effect from the reserves that limits the amount that the bank can actually issue, but generally speaking, they're going to issue as much as they possibly can. So what they're going to do is, and I'm going to demonstrate this visually in a moment, but basically what the bank is going to do is the bank is going to take the deposit. So let's say Grandma Esther puts money in the bank. She puts a $2,000 Social Security check in the bank. And that check is now a liability for the bank. They owe that to Grandma Esther. But that $2,000 on a balance sheet or a T account, as I'll show you, is an asset. The first 10%, so let's say 10% of their required deposits need to go to the Fed in reserves. So they take $200 off the top, and that's an asset to them because when they send it to the Fed, it's basically owed back to them in some way, shape, or form. In addition, the other 90% could be loaned out. It doesn't have to be. Maybe they withhold 5% as vault cash or 2% as vault cash and the rest is lent out. But let's just assume that there's an incentive for them to make it maximize profits by lending every dime out that's not in reserves, because they're like, it's already in reserves, so it's already there if we need it. So why would we hold even more money behind? So if that's the case, then that entire 90% is going to be loaned out. That $1,800 is going to be loaned out to somebody, and then that money is going to be owed back to the bank at some point, plus interest. And that's how they make their money. So on one side of the balance sheet, you've got a sum of $2,000. On the right-hand side of the balance sheet, you've got a sum of $2,000. But that person that gets the loan is going to buy something with it, and then the person who receives it, whether it's a business, an individual, is going to then deposit that money into another bank or the same bank. It doesn't really matter. That $1,800 is now a liability back to that depositor, but it's now less the loans, or excuse me, the reserves that go to the Fed. So in this case, $180. The remaining $1,620 is now going to be cycled back out in a form of another loan to somebody else, and that person's going to cash the check or deposit the check, put that in their account. So then that's a liability, and then 90% of that's going to go out as another loan, and then 90% of that's going to go to another loan, and then 90% all the way until all $2,000 of that initial deposit by Grandma Esther is in reserves at the Fed. So the way I can demonstrate that is, again, by a T account. So we have the first bank, Grandma Esther puts $2,000 in. So that's a deposit that's owed to her. $200 off the top goes to the Fed in terms of reserves. And then the remaining $1,800 is lent out. I should use block lettering from now on, but so I don't want to say L because I don't want that either. I want a pen. So loan, changing the colors on you. So loan, $1,800. Well, this $1,800 loan is going to be paid to someone, or else there would be no reason to take the loan out. So we go to a second bank. I'll change colors so we know it's a different bank. So now we have a second bank. They're now depositing $1,800 in this bank. So we have deposits. We have 180 going to the Fed because we have a reserve requirement of 10%. So the reserve requirement is 10%. And then the remaining 1620 is going to be lent out in the form of loans. And then that's going to go to another bank. And that bank is going to deposit the 1620. That's owed as a liability, but then they're going to send $162 to the Fed in reserves, and then the remaining amount, which is going to be $1,458, is going to be loaned out, and then the process continues to the next bank and the next bank and the next bank, all until the sum of all of the reserves and all of the banks is equal to the initial deposit. So that's how banks create money. And so when the Fed engages in open market operations and they inject money into the market, or if an individual deposits something in their bank, the amount of money that's created in the economy, so again, this is why money supply M2 also includes saving deposits accounts, because a certain proportion of that is going to be lent out anyway. So even though it's sitting in an accounting, from an accounting perspective there as savings, it doesn't mean it's sitting in a vault. It's not cash sitting in a vault. It's just a number that is corresponds with kind of the liabilities that the bank owes the depositors in a way. So the way money is created is, let's say that the Fed injects $1 billion into the economy, or someone deposits a $10,000 check in their bank. $10,000 or $1,000,000 is not, or $1,000,000,000 is not how much the actual money supply is going to go up. It's kind of like that spending multiplier we talked about in aggregate expenditures. When the government spends money, that money is cycled through the economy at the marginal propensity to consume until all that money is saved. Same thing as here, is that money is going to be lent out until all that money is withheld in reserves by the Fed, that initial amount. So there's going to be a multiplier effect here. So the actual amount of money that is injected into the economy is going to be some multiple of the initial dollar amount that is injected. The way we can calculate this is by calculating what's known as the simple deposit multiplier. So the reserve requirement ratio, or the required reserve ratio, is just the decimal portion of the reserve requirement as a percentage. So if the Fed requires a bank to hold 10% of its reserves, then the required reserve ratio is just 0.1. So it's as simple as that. If it's 20%, then it's just 0.2. So if we want to calculate the multiplier, we're just going to do, for this example, if it's 0.1, 1 over 0.1, which is 10. So the multiplier here is going to be 10. So if a bank customer deposits $5,000 and the reserve requirement ratio is 0.1, it's just 5,000 times 10, which is $50,000 is going to be the amount. So if the Fed injects $1 billion and the reserve requirement is 20%, then 1 divided by 0.2 is 5. And so we would end up with a $5 billion deposit as a result, instead of just $1 billion. So you could go through all of those T accounts until you have every single penny in reserve requirements, or excuse me, in the reserves at the Fed. It would take you a little bit of time. It would probably take you 25 iterations to make that happen, which would be a lot of writing and a lot of waste of time. So this is a shorthand way to get the actual answer. The T accounts are very important to help demonstrate how that money cycles through the economy, so please know how to do that. But generally speaking, the multiplier is the shortcut. Just like with the spending multiplier, you could take, the government sends $300 million and the MPC is 0.7, so you can do 70% of that, and 70% of that, and 70% of that, and add that all together once you're taking 70% of a penny or something like that. But again, that process takes a while, 20, 30, 40 iterations. You could just do this simple calculation and it's done. And you could even create a program that simulates it and shows you that that's the actual case and that it works. Another way to measure the circulation of money, so you're not going to be responsible for calculating this, is known as the Irving-Fisher equation. So the Fisher equation you know about is the real versus nominal interest and inflation. This is the MVPY equation, so it's not the most valuable player equation. Basically, the 4 factors here are money supply in terms of dollars. V is the velocity of money, and I'll explain that in a second. P is the price level, and Y is the level of real GDP. So if you take the money supply times the velocity of money, or you want to basically back out the velocity of money, you can multiply the price level. So let's say CPI is 200 and real GDP is $10,000. So then you would do $10,000 times 200, and you would get 200. You would get $2 million. So if the money supply is $1 million, then you would do 2 million divided by 1 million, and your V value would be 2. And so what that V, velocity of money, says is how many times will a single dollar circulate in the money supply. So it's kind of an interesting calculation that you can do on your own. Take the CPI, multiply it times the real GDP, divide it by like M1 or M2, and then that V will basically kind of back out an answer that's similar to the simple deposit multiplier that we just calculated. You could even compare them. And so basically this helps explain, okay, instead of it being like how much money is created by a single dollar, it's how many times does a single dollar get cycled through before it's kind of either sucked up into reserves or it's just not circulating anymore. So the last thing I wanted to talk about in this lecture is cryptocurrency. Unfortunately, at this time, I haven't really found a textbook for our course that really talks about it more than just an aside in a paragraph. And I think that's a disservice because as generational things change and as we move into a more digital age, cryptocurrency may or may not take flight and become like a world currency or be worth $1 trillion or be this more important currency. But the reality is that a lot of countries are starting to consider moving into a digital currency. And a digital currency is basically going to just emulate exactly what already exists out there with things like Bitcoin and Ethereum and stuff like that. So a cryptocurrency, unlike regular money, is something where money, you have a coin or a dollar or something like that. It's virtual, so it's secured by cryptography. So that basically means encryption. And so it's a security, it's a firewall, it's basically ones and zeros and binary code that makes it almost impossible to counterfeit or double spend. Now, you can have your digital currency stolen by hackers if you have a wallet. So basically, the tricky thing right now is that cryptocurrency, you can hold it in a digital wallet, but it's not necessarily, there aren't many institutions. Wyoming is trying to create institutions like this, and some other states are trying to start kind of considering the possibility of having crypto deposit in a bank like regular money. But as of right now, that's kind of not completely realized and visualized and seen. So right now what you have is like a digital wallet, so almost like the money under the mattress type thing, but instead of the money being under your mattress and someone has to break into your house, it's more so your money is floating in a wallet sitting somewhere on the internet in a cloud, and someone kind of breaks into the cloud and takes it. But it can't be counterfeited and it can't be double spent. The reason why this is the case is because of a technology that's known as the blockchain. So you might have heard of blockchain. And basically what blockchain is that it's basically a large network of computers that basically record transactions on a ledger. So a block is basically a certain size or bits of code that have to be kind of mined out and unencrypted by a computer running a bunch of simulated calculations to basically unlock it. And then those transactions that occur basically are using that technology to basically stamp the time, the amount, and the addresses of the people that made that transaction. The reason why it's hard to counterfeit or double spend this is because of the fact that unlike if someone stole your or had a dollar and it was fake and it kind of looked like the other one, the reality here is that because there's so many computers that are dialed into this blockchain, so let's say millions of computers, all of those computers are making a digital transaction record on their computer of the transaction occurring. So instead of it being like a paper ledger of a bookkeeper at like some small business where you could just kind of lie and change the numbers and cook your books as an accountant, you would have to hack into all a million computers and physically change it to the exact same thing in order to actually successfully counterfeit that transaction. So it's pretty much impossible to do. The difference between cryptocurrency, most of them, until we see the establishment of digital currencies by specific governments like China or Russia or the United States or the European Union, cryptocurrencies like Bitcoin are not backed by the government. They're backed by those that are facilitating the transactions. As long as people are recording the transactions, then there's a network there and there's a group of people that actually believe it to have value and the system exists. So whether the United States crumbles economically, or I mean, there'll be world ramifications as a result of that. But generally speaking, if you're holding a cryptocurrency and and you have some sort of failure of your country, maybe Venezuela or Zimbabwe, they have a situation where their currency gets inflated beyond their control or their economy kind of collapses, you can kind of shelter your money in this, and basically if the government starts printing money, your money doesn't lose value because it's got its own thing. So there are a lot of cryptocurrencies that exist out there. The one that's most common is Bitcoin. So there's virtual currencies. So like if you play a video game, you might actually purchase virtual coins that are basically limited to that universe. Video games have been doing that for a long time. But generally speaking, in terms of regular cryptocurrencies, Bitcoin is the one. It was the first, and it's worth the most at this point in time. So basically how Bitcoin works is that it is programmed to be finite. So one of the problems in terms of inflation is supply and demand. So the reason why the value of the dollar or value of a certain currency might drop is because that government starts printing money. And so if there's more money supply out there, then the exchange rate between a currency that's that's more scarce is going to have lower value than the one that's more scarce, and the one that's more scarce is going to have a higher value. So the way Bitcoin protects itself from that printing or inflation problem is it is programmed to stop at 21 million. So it's believed that I think it'll take 30 years to be able to mine every single Bitcoin, and at that point it's over with. There's never going to be another Bitcoin that's created. But as we get closer and closer to the 21 millionth being mined, the actual amount of Bitcoin that's created every time a block is created is diminishing. So it's called a halving. So basically the reward to a miner that's shared goes from creating a block and decoding this encryption to be able to record the transaction. If it sounds confusing, it is, but I'm trying to give you as kind of a most succinct description of it as possible without getting into too many details. So let's say you get 25 Bitcoins for mining something, so creating a block. Well, or uncovering a Bitcoin. Well, it's not really that you uncover a Bitcoin, it's more that you're getting rewarded for facilitating the transaction. As we get closer to 21 million, that might drop to 12.5 Bitcoin, then 6.25 Bitcoin, then 3.125 Bitcoin, all the way until the point where it's basically infinitesimal. Sorry about that. Infinitesimally smaller and smaller fractions of the Bitcoin. And a Bitcoin is divisible by 100 million, so it could be real small. And the theory is that as that scarcity kind of starts to become more realized, then the value of it will become higher as other countries start to inflate and provide liquidity. But Bitcoin is not the only cryptocurrency. There's other ones. There's Bitcoin Cash, which is a fork of Bitcoin. So basically, it's almost like a split stock on the stock market. Basically, the people that are mining the Bitcoin or participating in the blockchain, they can have a democratic vote about whether or not they want to create a new version of a cryptocurrency based on the existing cryptocurrency, because maybe they don't like that it's public, or maybe they don't like the underlying technology, or maybe they don't like that there's only 21 million of it available. So what they do is they basically try to create a separate version of it, and it's like, well, we're going to create this new form of Bitcoin, and it's going to have 100 million coins available at the end. So every person that owns one Bitcoin is going to get 5 Bitcoin Cash. And so that can happen. And it's almost like a split stock, and they have different, but it has different values than Bitcoin itself. So Bitcoin could be worth $11,000 and Bitcoin Cash can be worth $400. And Ethereum is a different type of blockchain technology, but it's not actually that hard to create a cryptocurrency. But in order for it to have value, people have to, again, accept it and believe it to be valuable, because it's still a fiat currency. It's not like I can really do anything with some ones and zeros and binary code. It's a fiat currency, but it has scarcity. It's defined scarcity. And it's not backed by a government, which is why it's attractive to people. And then you have others like Tezos and Dogecoin, which is based on a meme and not worth anything hardly. So the last question is cryptocurrency money? So again, it boils down to acceptability and value relative to size. So a lot of people are iffy about cryptocurrency because it's just digital. So like, how do we know that it has worth because of the fact that it's not big or discernible or things like that? This is kind of the argument as to why the music industry and a lot of industries have lost value. So I think the value of the music industry has dropped, I think 70 to 80% in the past 20 years, mainly because of the fact that we transitioned from albums and CDs and cassettes to MP3s and streaming. So like, when we had the MP3 and the iTunes revolution, instead of buying a whole album for like $10 just so you can listen to one or two songs that you really like, and then the other songs are still good, but you're really buying it for those two songs initially, it went down to, oh, now I could just buy the songs that I want for $1 or $1.29 or something like that. And then it went to, I can listen to whatever music I want for $10 a month. So when you go from one where you could sell millions of albums for like $10 to $20 a piece, to, oh, I'm only going to sell a couple of songs at a time for $1 a piece, so there you go, you lose 80% of your revenue right there, to, I'm only going to get paid based on how many people listen to my song, based on a already predetermined pot of money like Spotify or Apple Music or something like that, where they have 50 million subscriptions, 10 million or $10 a month plus the advertising revenue. So we have $500 million plus ad revenue to distribute amongst all of the artists based on the amount of listens they have. So if you have 1% of the listens, you get 1% of the artist pot, which I think is 70%, not even 100%, because the company actually has to make money too. So basically, if you have 1% of the listens and 70% of the pot of $500 million goes to that, you can make a decent chunk there, but it's just shared amongst everyone. So the industry is limited now. So the music industry has kind of shifted to like experiences, and live music has kind of been like the main way in which artists make money now versus actual selling of the music. I mean, it's always kind of been that way, where the artist really only makes money through the tours and the merch, but now that's more so than ever. Because the reason why that's the case is because of the fact that, again, when you have a physical album, there's some value to it. It's the reason why vinyl exists again and it's popular, is because of the fact that people like something so much they want to have a tangible connection to it. So they'll buy a $30 vinyl, but not everyone buys a $30 vinyl, and not many people buy a $30 vinyl, but it gives them some piece of artwork or some tangible connection to something that they enjoy. But otherwise, I see how convenient it is and how cheap it is. And I even think about Spotify with a freemium model. Like, I paid for Spotify, I still do in some ways, but there are periods of time where I don't pay for it, and I just use my computer, and I can tolerate 30 seconds of commercials to listen to things that I had to basically pirate off the internet or hope for a mix CD or buy an album from family or from a store to be able to even listen to and enjoy, that I can that I can access so easily now. So it loses value because of the fact that it's so easy and you get convenient to it and you get used to it. So the concern with cryptocurrency is that people will get kind of complacent. They don't really understand that it has value because I never see it, I can't touch it. They kind of like conceptualize an image of a Bitcoin on like websites, but it doesn't exist. It's not there. It's just digital code. So people don't really think that it should be as valuable as it is. So like if a Bitcoin becomes worth $1 million, why is that the case? But the counter argument to that is that if we're going to have digital currency in the future anyways, backed by the United States government, what's the difference? The counter argument also is that it's already got a scarce value. It's predetermined. It's 21 million. You can't do anything about it. So like the U.S. could create 100 quadrillion digital dollars that completely devalues the currency, and there's nothing that you can do about it. But with the cryptocurrency, it's finite, so basically it's limited to that, so it can appreciate in time over value. And then acceptability is a big problem. So a lot of people aren't quite sure how they can spend it. So maybe there's coffee shops in Brooklyn or something like that that accept cryptocurrency. Amazon from time to time, they might do it more consistently now that accepts cryptocurrency. Other websites that'll accept cryptocurrency for general transactions. But traditionally, people are kind of against it because the original transactions were usually dark web or counterfeit or illegal transactions because it was a way to kind of launder money. But now that the IRS is starting to see it as tangible and usable and fungible in the future, they are starting to they're requiring reporting on taxes and things like that because it's got value to them. Right now, most people, though, treat cryptocurrencies as assets. So money in the long run will probably typically stabilizes. Good money stabilizes. But I mean, the United States dollar has had times of inflation, and most currencies have. So this time of fluctuation with Bitcoin and other cryptocurrencies is usually a situation in which it's trying to find itself and figure out, okay, well, not many people are using it, so it's going to have these big up and down things. But then as time goes on and more people use it, it has these network externalities of acceptability, then the price will start to stabilize and it'll stop being an asset that's kind of going to go from 9,000 to 14,000 back down to 3,000, and people make money and lose money substantially overnight because of it, and then based on the time in which I convert, I'm going to make a bunch of money or lose a bunch of money. It'll start to stabilize and actually mimic that of a currency instead of an asset. So some people are investing in it as an asset, a long-term asset. In fact, like a lot of financial analysts suggest that maybe it's like some people think it might be gold. It might not actually be money that you buy stuff with, but it might actually be gold, where it's kind of like a commodity asset that appreciates over time that you can kind of have as a safe haven. And then other people just see like, well, you know what, like someday, like it might be an asset now, but I don't really see it as an asset in 20 years when everyone's using it for their transactions. So if I have 5 Bitcoin now and then 1 Satoshi becomes $1, which is 1/100 millionth of a Bitcoin in 20 years, then that's my retirement account. And I also know how to make and now I also have it and I can actually make transactions with it instead of having to convert my dollar, which may or may not have value in the future, to that. And that's not to say that the dollar won't have value, and that the dollar is going to collapse or anything like that. That's not what I'm saying at all. I'm just saying that it's a potential alternative to kind of represent what we're headed towards with our technological future. But in any event, as it becomes the future, there should be no reason why it isn't included in a discussion about money. So that concludes this lecture. If you have any questions, please feel free to ask me any questions. And our next lecture will be about fiscal policy. Good luck on any assessments that you have for me or any other course, and I look forward to talking soon.